Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for Chapter 8 of our textbook for cost and managerial accounting. And we talked last week about where we were going in Chapter 8. And I'm going to kind of just point that out again as we get into the PowerPoints. But basically we're looking at so when we did that flexible budget performance report last week, we calculated the variance or the difference, and then we looked at whether that was favorable or unfavorable. And so now we are investigating or drilling down on those variances to determine where they came from, right? So we're investigating those variances a bit more. And just like your book talks about, and I kind of mentioned in class last week, that, really they consider this like management by exception is what they call it. So when we're calculating these variances and we're analyzing the financial statement information and the performance report data, we're going to be investigating the larger variances, especially unfavorable variances. But also, if we have a large variance, even if it's favorable, we might want to investigate that and see how we can replicate that. Basically, we can duplicate that and make that happen again, right? If it was a positive result. So anyway, that's where we're going in Chapter 8. So I'm going to get my screen shared with you, and then we will go over these PowerPoints together. Okay, so Chapter 8, again, we're looking at standard cost accounting, materials, labor, and factory overhead. And we're going to look at ways that we can drill down on or analyze these variances better. So that's what we're looking at here in Chapter 8. Okay, so some of our learning objectives: describe the different standards used in determining standard cost, determine procedures for recording standard costs, compute and analyze variances, prepare journal entries to record variances. So again, some of this that we're going to get practice with. So this Cortez Manufacturing, this was that flexible budget performance report that we did in class together last week, right? So remember, this was our budgeted data, and this was our actual data. And then we calculated the difference or the variance, and then we said whether it's favorable or unfavorable, right? The U for unfavorable, obviously the F for favorable. So, we'll just go through a couple of these items. Sales, for example, we budgeted $125,000 for 5,000 units. It was actually $120,000. So that was a $5,000 variance, and that's unfavorable, right? I mean, just like if we think we're going to get paid 125 bucks and we only get paid 120, right? That's unfavorable variance. Direct materials, we budgeted 25,000. We actually had 26,000. That's $1,000 difference or variance. And again, that's unfavorable. We expected the cost to be 25. It was actually 26. So that's unfavorable. Direct labor on this one, budget was 15,000, actual was 14,000. That is a $1,000 difference or $1,000 variance. That one is favorable, right? Because we expected to spend 15, we only spent 14. So that's a favorable variance. But just like we said in class together, now in Chapter 8, we're focusing on these variances and we're drilling down and kind of investigating these more. So with direct materials, we had this $1,000 unfavorable variance. So if we think about direct materials, okay, is this $1,000 variance because, is it a price variance? Is it because we paid more for the materials than what we budgeted? Or is it a quantity variance? In other words, we used more materials than what we budgeted for that number of units, right? So we can kind of drill down on that, investigate that. This direct labor variance, again, it's a favorable variance, so we might not spend too much time investigating it, but we might want to potentially look at replicating that in the future and paying less than what we budgeted in the future. So we can drill down on that and we can determine, okay, do we have a favorable variance here because we paid our workers less per hour than what we budgeted? The direct labor rate is less per hour than what we budgeted, right? Or do we have this variance because our workers were more efficient than what we budgeted? So there's a labor rate variance and a labor efficiency variance. And then same thing with overhead. We can drill down on overhead and we can look at the variance in overhead. And when we're looking at the variance in overhead, generally we're comparing, the flexible budget number with what actually happened. Just like we see here, we just break that down a little bit more. So anyway, we'll see examples in the PowerPoint and then get some practice with it together. So standard costing, we've already gotten practice with this really in chapter 7 when we were looking at the different budgets, because our budgets are based on standard cost, right? The numbers that we use to prepare our budgets are based on our standard costs. So, although we didn't necessarily identify them as standard costs when we were preparing our budget, that's exactly what they are. And that's where our budget numbers come from, right? So, for example, with materials budget, if we have a standard cost of $3 per pound and we use 2 pounds per unit, that's going to be a standard cost of $6 per unit. So that's how we set our budgets and how we calculate our budgets. So we're going to look at that standard costing together. And it talks about a few different types of standards that we can use. And I'm trying to find in our book where exactly this is at. I have the textbook open for us. Oh, where's it at? Hot dog. It talks about this in chapter 8, page 415. It looks like, so using the standard cost system, we can use the practical standard, the ideal standard, the attainable standard. Again, you can, if you want to read more about these, but generally speaking, we use that first one, right? That practical standard. And then accounting procedures for standard costs. So just like it shows here, standard costs are determined for the 3 elements of the manufacturing cost: direct materials, direct labor, factory overhead. The standard costs are what we base our budgeted data on, and then we compare that to the actual cost. The variances between the actual and standard cost are recorded in the appropriate accounts. And then any significant variances are analyzed and investigated, and then appropriate action may be taken. So material cost standard is based on estimating the quantity of materials required for a unit and then the cost of the materials per unit. And so that's why I mentioned looking at that flexible budget performance report, we can base or we can break down a material variance into either a quantity variance or a cost variance, right? Did we pay more for the materials than what we thought, or did we use more or less of the materials than what we thought, right? Than the standard. Same thing with labor. Labor cost standard is based on estimates of the labor hours required to produce a unit of product and the cost of labor per unit. So labor hours required, this is our efficiency variance. How many labor hours does it take to produce a unit? And let's just say that we say it takes 1 hour to produce a unit, but if our workers are doing it in 45 minutes, right, that's going to be a positive or a favorable efficiency variance, right? Or the labor cost per unit, this is a rate variance. So if we have a favorable, like we had in our example, Cortez Manufacturing, if we have a favorable labor variance, maybe we paid less per hour. Maybe we paid our workers less per hour than what we budgeted for some reason. So labor variances we can break down into either a labor rate variance or an efficiency variance. And then just like it shows here for overhead. So the variance, again, the difference between the actual and the standard cost. And then variances measure efficiencies or inefficiencies in usage and price. And this is the same thing that we do for overhead. And so this kind of shows us, again, we're going to get practice with these calculations together because the PowerPoint slides, really don't give us very good examples. But if we're thinking about that direct materials variance, again, we can break that down into either a price variance or a quantity variance. When we're thinking about that direct labor variance, we can break that down into a rate variance or an efficiency variance. And then factory overhead, again, the way that we look at that is looking at our budgeted performance report data compared to what happened, and it does show us that in the PowerPoint slides in our textbook. So just like it shows here, a debit balance in the variance account indicates an unfavorable variance. A credit balance reflects a favorable variance. And so when there's an unfavorable, oh my goodness, when there's an unfavorable variance, that's going to increase our cost of goods sold, right? We're going to end up increasing cost of goods sold for that unfavorable variance. When we have a favorable variance, we're going to end up decreasing cost of goods sold. And so we'll see that with the journal entries. And so on here, it's showing us, again, I'm going to try to blow this up a little bit for us. So it's showing us how we would calculate that materials variance. Basically, we're taking actual cost times actual price per unit, actual quantity used times actual price per unit. That gives us actual cost. And then we're comparing that to actual quantity used times the standard cost per unit. So, I know it's got the numbers plugged in for us, and that's wonderful. But if we were looking at this without even doing the calculations, if we had an actual price of $3.90 per unit and we budgeted $4 per unit, we know that's going to be a favorable variance. We're paying less than the standard. We're paying less than what we budgeted, right? And then we take for the efficiency or the materials quantity, equivalent production times the standard quantity per unit times the standard price. So in this case, the materials that should have been used, we produced 10,000 units. We should have used 1 pound per unit, which would be 10,000 pounds. We actually used 11,000 pounds. So that's an unfavorable quantity variance. And then overall, the net of these two. So we've got you think about the favorable like a positive number. You think about the unfavorable like a negative number. So overall, we are negative 1,800, 1,800 unfavorable, right? That's the same thing we do with these labor variances. Again, we can break it down into a labor rate variance or a labor efficiency variance. We think about an unfavorable like a negative number. We think about a favorable like a positive number. So overall net effect is 5,000, or excuse me, 500 favorable. All right. So just, and I mentioned this a moment ago, work in process is debited with the standard cost. Material inventory account is credited for the actual cost of materials issued to the factory. Payroll account is credited with the actual cost of labor incurred for the period. The differences between the debits, the standard cost, and the credits, the actual cost, are debited for unfavorable variance, credited for favorable variance to the variance accounts. The standard cost of units finished is transferred from work in process to finished goods. And again, what ends up happening if we have an unfavorable variance, it ends up increasing our cost of goods sold. If we have a favorable variance, that decreases cost of goods sold. And so that's what it's showing here. Prorated or prorate variances to cost of goods sold, work in process, and finished goods show an unfavorable net variance as an addition to cost of goods sold for the period, and a favorable net variance as a deduction from cost of goods sold. Uh-oh. I don't know what I just did, but it's pulling up weird stuff on my. Oh, wow. Stop that. Okay. Okay. Disposition of variances. Again, we talked about the unfavorable variance gets increased in cost of goods sold, or increases cost of goods sold. Favorable variance decreases cost of goods sold. Disposition of variance. So if production is seasonal, then the variances should be shown as deferred charges or credits on interim balance sheets. Variances due to abnormal or unusual circumstances should be charged off as extraordinary losses on the income statement. We talked about this with material variance. For example, we can investigate a quantity variance or a price variance. And as it's showing here, management should not look at each individual variance, but rather at the relationship of that variance to other variances. So, if we, for example, had a favorable efficiency variance, which means that we produced a number of units faster than what we budgeted. The time we were more efficient, then theoretically speaking, that should also make our factory overhead a little bit less than what we thought, right? We should also have that relationship between labor and overhead as well. So that's kind of what it's saying here. All right, so that again, budget numbers, a budget is a good plan based on usually historical cost and what has happened historically, but it's not 100% set in stone. As we saw, we can be over budget, we can be under budget, right? Things happen. So because these are based on estimates, they are subjective in a sense, right? They can change depending on different levels of activity, or lower prices paid, or greater efficiency, whatever the case may be, right? As those types of conditions change, so will our variance and our budget data. So just like it's showing here, the purpose of using a standard cost system is to provide continual incentive for factory personnel to keep cost and performance in line with predetermined management objectives. Some of the questions that we might be able to ask or answer, rather, a standard cost system helps focus management attention on the following questions and their causes. So were materials purchased at prices above or below the standard? We're going to see that in the material cost variance. Were materials used in quantities above or below the standard? Again, that's the material quantity variance. Is labor being paid at rates above or below the standard? That's the labor rate variance. Is labor being used in amounts above or below the standard? That's the efficiency variance. So again, those are some of the questions that we answer in doing these calculations. All right, so for overhead, again, for overhead, we can also look at a variance, and we're looking at, basically the budgeted data versus the actual data. And so just like it's showing here, if actual overhead is greater than applied overhead, we have an unfavorable variance. If actual overhead is less than applied overhead, we have that favorable balance or favorable variance. And so the two variance method, which is used most often, like your book tells us, the two variance method of overhead analysis breaks down the total variance into a flexible budget variance and a production volume variance. But basically looking at the flexible budget according to what actually happened, right? Like we did in chapter 7. Flexible budget variance measures the amount by which the actual factory overhead costs differ from the flexible budget for production attained. The production volume variance measures difference between the budgeted fixed overhead and the fixed overhead allocated to work in process. Oh goodness, that was our last slide. I thought I added a slide with some of our exercises here, but that's okay. We will we will get practice with that together. So anyway, hopefully that helped your understanding. I know we kind of talked about it when we went over chapter 7 in class, but as always, once you guys read through the chapter and are able to watch this this recorded lecture, just let me know if you have any questions. I'll see you guys soon. Bye-bye.